Yeah, I mean, we're a big believer. We're asset allocation nerds at heart. So, efficient frontier optimization, both equity and debt in the EM is in the bloodstream.
And I think you do need to do what we call emerging markets 3.0, Mike, which is leave out the legacy economy and buy the consumption story. And consumption has changed here.
That's Corey Franco, founder and managing partner of Noble Bridge Wealth Management, and Kevin Carter, founder and chief investment officer of EMQQ, respectively. We want to thank EMQQ for sponsoring the live Think Tank Exchange and this podcast.
Our guests are making the case for investing in e-commerce in the emerging markets. I'm Kedar Wilson.
I'm Dave Armstrong, and thanks for joining. Hi, Kedar.
Dave, great to be with you.
Our value proposition is to enhance yours. And before we get into today's podcast, I'd like to let listeners know that attending the live ETF Think Tank Exchange enables you to earn CE credits. These are always lively conversations and a great way to learn and get credit.
Our goal in both the live show and this podcast is to provide thought leadership by bridging the gap between investment producers and the advisors who use their products through actionable ideas.
And to that end, in this podcast, which offers highlights from the live show that was hosted by our own Michael Venuto and Dan Weiskopf, our guests are making the case for emerging e-commerce and talking about portfolio construction.
And Dave and I will return later with ideas that can make a difference. Plus, our advisor guest, Corey Franco, talks about a noble cause, Autism Speaks. But for now, let's jump into the highlights.
Great.
So Corey, what are your thoughts about the emerging markets? How have you handled that category?
Yeah, I mean, we're a big believer. Look, we're asset allocation nerds at heart. Efficient frontier optimization, both equity and debt in the EM is in the bloodstream. So we're a big believer, and it's not just from an asset allocation standpoint. The background, if you would, of the flight path, if you would, is there. The consumer, the demographics, the emerging countries, growth, the engine that is all there, and so we're a big believer, and we do allocate both on the equity and the credit side. Depending upon the risk, somewhere in that 3 to 8% target is kind of our sort of thumbprint there. And again, we do look at both equity. We will use thematic as well as broad-based, where we feel there's a little bit of a tilt or view, and that includes country specific. And then on the EM debt side, just very, very focused on credit. I think that's really the spot that we would focus on there.
And it's because I've seen the growth there. So I'm curious, love to hear your thoughts as well on that, Kevin.
Well, I would say that, first of all, I'm biased in thinking about this, but I've also become pretty radicalized about how investors should allocate to emerging markets. And I've also become pretty radicalized about modern portfolio theory and efficient frontiers in general. And Mike, as you know, the biggest problem to me is that the traditional emerging markets indexes and the ETFs, whether that's the China ETF or the broad emerging markets ETFs, they don't capture the growth. I mean, there's been a ton of growth in emerging markets, but the stocks that are in the traditional funds, they track the legacy economy, and they're full of, most importantly, government-owned banks and oil companies. And, this is something I learned in the first 5 minutes after Burton's talk 15 years ago when we got back to the office. And I said, give me a list of all the companies in the China ETF, because I figured we'd just buy the iShares China Fund for our guys at Google. And Burton warned me before they gave me the list. He said, look, when you look at all the companies in the fund, it's going to be all government-owned banks and oil companies. And he explained how they operated and how the banks would make loans to companies that were already basically bankrupt so that they didn't lay off employees. And, with my simple Omaha brain, earnings equals value, and the growth of earnings equals the growth of value. And if the companies that are in your fund don't care about that, why would you invest in them at all? And In the case of the China ETF back then, it was 85% state-owned enterprises. And in the case of the Vanguard and iShares, the traditional broad emerging markets ETFs, they're about 33% in SOEs. And if you counted the former Soviet SOEs and the chaebol in Korea, it's about 50% of the index. And these are not real companies. And so people, time and time again, I see people say, look how cheap emerging markets are. Their PE is 12 or 13, and the economies are growing twice as fast. How can that not be a bargain? And the reality is that's the biggest value trap in the world. If you're waiting for the MSCI Emerging Markets Index to catch fire, you're going to keep waiting. People say, well, it's been a lost decade for emerging markets. They haven't made money. And it's true. The broad indexes in the last 13 years are down a point or two. So I don't think you should allocate anything to emerging markets if you're going to buy the iShares or Vanguard funds. And I think you do need to do what we call emerging markets 3.0, Mike, which is you gotta leave the traditional approaches behind, and you gotta get precise in that allocation. And again, I used to tell people to buy leave out the legacy economy and buy the consumption story, and there's a ticker for it. But just as consumption has changed here, it's changing there, and except it's a lot bigger of a deal. And because really, Mike, there's three themes. EMQQ is really a great confluence of three mega trends happening at the same time. You got billions of people in the world moving on up, and they want stuff. They're getting their first ever computer. So the second theme, the second mega trend is called the computer, which we take for granted.
Or the phone.
That's right. But, I had a computer for 20 years before I got my smartphone, which I answered that call on 7.5 years ago. But most of the world's never had a computer. So all those billions of people are getting their first ever computer. It's not on their desk. It never will be. And it probably doesn't have an Apple logo. So these people, again, 85% of the world's people, 90% of the people under the age of 30, they're getting their first ever computer. It's a $50, $60 Android-based smartphone. It's in their pocket. And it comes with the third mega trend, which we also take for granted, something I've had for 25 years called the internet. So while I got internet access, in San Francisco 25 years ago on a telephone line with a modem and then over the cable, most of the world's never been wired. And so when they get that first smartphone, they're getting their first connectivity via mobile broadband and Wi-Fi. And you combine those three mega trends, and the result is that, this is, I think, quite literally not only the fastest growing sector in the world today, but the fastest growing sector ever in terms of revenue growth for public companies.
So, I get a lot of questions often about, China and why, what's happening with China? Why do we have to be there? And personally, our view and my view particularly is, you can't ignore China. And in the case of EMQQ, it's broad, right? Corey, when you have conversations with clients, what are you hearing? What are their questions that you have to answer?
Yeah, I would say the biggest and most consistent question is, why are we allocating the EM? As basic as that is, there is a steep learning curve and perhaps a lack of savviness in some instances with retail investors, in that they just don't understand the backstory, the demographics, the dynamics, the 3.0. They just don't necessarily, it doesn't resonate out of the gate. And so there is a level of education and research that needs to be provided to demonstrate the value prop and the valuation reasons as to why we allocate. And then again, it's, retail investor, is not looking to put 20% in EM. They're more like, okay, well, not really something I was thinking about. So let's start with that 5% kind of guideline, right? And so there is a little bit of having to step in and walk folks upward into the risk spectrum with regards to the historical risk aspects of EM And so it is a little bit of a process. It's not as a bit of a cookie cutter. This is it. So there is a process. It does need to be explained. It does need to be figured into the client. I would say on a case by case basis often.
Yeah, I get the content flow, but
yeah.
I'm curious what's resonating with that end investor today.
Sure. So good example was the recent IPO of the South Korea equivalent of Amazon, right? Coupang, like that resonated, right? And so then you can utilize that opportunity to really kind of elaborate further on why this part of the, what this region, this part of the world. And so it is internet, it's the demographics, it's the movement, out of the cities. But really, I think the IPO market in recent with the South Korea play really started to get folks to say, geez, okay, you know what, there is opportunity out there abroad, and we should be trying to tackle some of this here. So that's kind of what also plays in.
Okay, so let's ask Kevin kind of the same question. Kevin, what stories, what themes within your worldview are resonating with investors today? Is it the IPOs that are getting people excited?
Well, lots of times people get excited about IPOs, and Coupang is actually an amazing company. And look, it's pretty simple. I mean, I think that Corey nailed it. Like, everybody in the world knows what Amazon is and how it's become a bigger and bigger part of their lives. They know what Netflix is. They know what Google is. They see how their consumption's changing. And that, there's a reason why people gravitate towards that, because they're doing it themselves. And when you point out that we're on the cutting edge, right? We've had these things. We've had Amazon. We've had computers. We've had internet access. And it's changed our lives. And you then step out of the United States and realize that 90% of the people in the world under the age of 30 are in emerging markets, and they're becoming consumers, but they're becoming consumers and digital natives. And so all of the things that people in the US are doing that resonate with them are happening to all of these people around the world. But the important difference is these people, the consumption infrastructure in the emerging markets is undeveloped by definition. So they don't have bank accounts with debit cards. They don't have TVs on the wall with 1,000 channels, and there's no Target store. And so they're leapfrogging to digital consumption. So it's this ideas like Coupang, the Amazon of this country or the Amazon of that country that resonate with people. And the IPO pipeline's going to continue to pump out companies, because this story is spreading all over the world. In the next couple of years, the India story is going to really start showing up on CNBC and in the newspapers, because the Indian IPO market is going to start to flow and be a big deal.
Yeah, Carter, you bring up some really interesting points. I mean, this is just starting, is what you're highlighting, right? And you've got roughly 100 names embedded in the strategy. How do you go about selecting different stocks in it? And I understand you rebalance twice a year too.
Yeah, well, this is a straightforward approach. It's a rules-based index, and there's basically 3 rules to be included. The first and most important rule is you have to be an internet or e-commerce company in frontier or emerging markets. And that may sound simple, but one thing about emerging markets I've learned is the databases don't always reflect the reality of the company's financial statements. And so we don't care what stock exchange you're on. We don't care what country you're domiciled in. All we care about is where the revenue is. And this was a real problem. And, when I first got involved with China 15 years ago, and I asked for the list of the companies in the FXI, the iShares China, I went down the list and Baidu wasn't included. And I said, where's Baidu? And the index people said, well, we don't include Baidu. It's not a Chinese company. And I said, what do you mean it's not a Chinese company? It's the Google of China. And they said, well, but it trades in the United States, so we don't include it. Now, that problem didn't get fixed until 3 years after Alibaba came public. So Alibaba was not in the Vanguard or iShares funds when it went public. It took 3 more years for them to finally change the rules. So First rule is we don't care where your stock is. What we care about is where the revenue is coming from. And as long as you get more than half your revenue from emerging markets, internet and e-commerce activities, if you have a market cap of 300 million, daily liquidity over $1 million US, you'll be included in the fund. And as you said, it's rebalanced twice a year, June and December. So that's when we pick up new IPOs and rebalance. And it's market cap weighted with one modification, which is we limit the largest position to 8% at the time of the rebalance.
Okay, so I just looked in our ETF think tanks tools, and I can see that compared to the MSCI index, you've got 82% active share, meaning you're 82% different. There's only 18% overlap. So it's a very different portfolio once you construct it. And Corey, I'd like to ask you, is that kind of a metric that advisors can look at? Or is it like when you're trying to select something, are you looking at things like that, the difference versus the similarities?
Yes. And in fact, I actually think it's a good indicator to utilize. We do look at that to really gauge, obviously the drift and the excess, but I think it's a good thing. In fact, I think it could be a very good indicator to help narrow in and make your selections. To Kevin's point, I mean, these broad-based EM, benchmark-based funds are not going to always capture and have their nuances of isolation or exclusion. And so looking at that active share component as an indicator is very helpful. Now, do most advisors do that? I can't speak to. I think it really depends on, your own individual process. But, I definitely think there's value there.
Okay. So while I was in here, I also looked at the China exposure, which is pretty high. Now, we don't usually get to questions till later, but I literally have 3 questions already, and they're all asking the same thing: China. So, they're all angles on China. Do you think about the accounting? Do you think about what's going on with restricting? Do you think about trade wars? Do you think? So they're all angles on it. But Corey, let me ask you: do you hear concerns about China from your clients? And then Carter, same question, but more of, what are you doing in the portfolio to address this sort of stuff, the China and the state-owned enterprises? Because I can also see in our software, you have very low exposure to the SOEs, but it's high to China. So Corey, you hit China first.
Sure. I would say, outright, there has been a degree of resistance and lack of understanding and just pure concern as to, allocating to, China. I think there is a little bit of this good, bad thing going on in retail, clients. And I think that when you start talking China, it becomes a little bit of a, it's like, whoa, okay, hold on a second. Let me make sure I understand what we're talking about and what we're doing. So there is a little bit of a learning curve there. There is a little bit of resistance. Some folks just want to be 100% domestic, and that does happen. And so it's tough. It does make it a little bit of a tougher. But again, I mean, back to the Amazon equivalent, right? I mean, we've seen the same thing with Tesla, with NIO, right? And so when you can start to pinpoint examples for folks, then it softens them up, right? And then you get a little bit deeper. And yes, the accounting questions do come up with your A-type investors. And the math folks really want to understand, well, is this equivalent? There's disadvantages, and so it can get a little complicated. So we do try to address some of those concerns. And again, looking at things a little bit more broad and thematic, we're able to solve the needs. All
right, Kevin. Everybody's got China questions.
I know. Well, look, I've been answering China questions for 15 years. My first presentation I gave about China 15 years ago was at the FPA in Texas. And my first question was, when will China launch a war to capture women, to handle their mismatch of male to female population? So I've had every question on China. Let me just say, as a high-level statement, I think all investors would benefit if they could take all of these negative stereotypes they have about China and discount them at least some percentage, because I think that, because I hear this all day, every day from people. They don't trust China. They're cooking the books. Jack Ma's missing, a bunch of stuff that's just not real. And most of the people that make these comments have never been to China and seen what's happening in China. So let me deconstruct the big issues and address them individually. In terms of, can you trust their accounting? Are they cooking the books? The reality is, the reason that most of these companies have gone public, not just the China companies, but the other emerging markets internet companies, is because they're getting backed by Harvard and Stanford and corporate investors like Berkshire Hathaway. And so this is why they choose to list here. So these companies, on a relative basis, the internet companies have exceptional corporate governance, which is your biggest problem in emerging markets. And that's why these companies end up trading here. In terms of, and by the way, let me also make this important comment about the accounting. There was one relatively high-profile accounting scandal that occurred, Luckin Coffee, about a year ago. This was a Chinese supercharged Starbucks competitor. There was a real company that ended up manipulating their revenue to try to keep up with the street. That happened, and that company, I think, was delisted and lost a lot of money for people. But the reason that we have these rules like Sarbanes-Oxley and the rules tied to the threat of delisting these Chinese companies is because of Enron, which was the most respected company in the United States. So scandals happen and accounting problems happen, and we haven't had any of our companies that have accounting issues, but likely at some point we will. That's just the way the world works. The real problem, and the thing that's made people very wary of China, are the penny stocks. There's still 125 or 150 of these penny stocks that are pump and dump, Wolf of Wall Street schemes. And this is not a China problem. This is a Long Island and Florida problem. And
hey,
when I got the list from the PCAOB of all the companies that were, not in accordance with the accounting review rules, I was shocked that these things still existed, because I thought this problem went away when people lost all their money in these things 12 or 13 years ago. There's even a documentary on Hulu called The China Hustle about this problem. But that group of companies has given the entire list of Chinese equities a black eye. And, you're throwing the baby out with the bathwater if you're going around thinking you can't trust these Chinese internet companies. They're making up the numbers. That problem was created by not Chinese people. So I don't worry about the county. In terms of the Chinese government and the heavy hand, and it was Jack Ma missing, and they're going to steal Alibaba. These things are also have 0% chance of happening. The Chinese government understands capitalism better than our government in many ways. Most of their leaders have been educated at our best schools. The guy that runs the equivalent of the Fed for China was an economics professor in Illinois. So these people understand capitalism. And in regards to the recent specific issues with Alibaba, look, the Ant Group IPO failure, everybody looked to the negative of that. The reality is, I think the regulators were right. That company was creating a ton of credit and not being regulated like a bank. And when it first got pulled, I thought it was sort of a classic balance between the regulators and Jack Ma. But I now think the regulators absolutely had to slow down what was happening there. And in terms of the antitrust threats, all over the world we have monopoly rules, and the goal of any company is to become a monopoly, really. And so if you're getting close to that, I think that's more of a sign of strength than anything else. So I'm not worried about the Chinese government or the Chinese accounting as part of this story, but I know everybody else is.
Kedar, hey, it's at this point that we always like to come back and summarize some of the key ideas that were discussed in the presentation today. What were some of the ideas that caught your attention from both Kevin and Corey in their discussion?
I think they're focused on the IPO market. Corey, for instance, mentioning recent IPOs in South Korea. That's equivalent with Amazon. I think that was very intriguing and insightful.
I thought that one of the things that Kevin talked about was the idea that investing in the emerging markets really doesn't get you the kind of exposure that you're thinking about, that disruption in the emerging markets is really happening with technology. And so his focus on the internet and e-commerce themes, his ability to see and distill where that focus should be as an investment, I think for advisors and investors can be a very powerful tool.
Absolutely. And I love the section where they really went into the portfolio construction and how Kevin is so knowledgeable in regards to, why the allocations are the way they are, the particular positions in the fund.
Kedar, the Corey's perspective on allocating to the emerging markets, I think for most advisors is also incredibly important. In investing, we tend to have what's called a home bias. We invest in the things that we know and can see that are almost at arm's length. Or at arm's reach. But if you think about many investors looking into the developed markets, looking into the emerging markets is especially hard to do. And so their ability to provide as Corey was talking about, an allocation to the emerging markets combined with addresses their home bias for their investors, but it also becomes an incredible tool for them as well.
I think what was very interesting as well, Dave, is Kevin's mention of what he called the Great Confluence. And this is a chapter from McKinsey that calls the best growth story in history of capitalism. It's really billions of people that are moving on up with stuff that they want, and they're getting connected to the internet for their first time, and where they have what is a computer in their pockets, their cell phone.
One other thought as we come to a close, I liked Michael Venuto went to our ETF think tank and pulled some data that is a powerful tool for advisors as well. He compared the strategy to an MSCI EM index, and Michael commented about the fact that there was an 82% active share, meaning that there's an 82% difference and only an 18% overlap between Kevin's strategy and investing in a traditional passive index fund. That's powerful information for advisors, and one of the other areas where we can make a difference to help inform better decision making for both advisors and for their investors.
Absolutely.
Well, we always like to end our episodes talking about a worthy cause, and one that's close to Corey Franco is Autism Speaks. So we'll let him speak to that.
Sure. Autism Speaks. Autism is often overlooked. And so it's a near and dear one to me. I do have a 9-year-old who is autistic. So as a father, you see firsthand what the impact is. April is Autism Awareness Month. So I thought it was quite fitting. And so it is a very important one to continue to strengthen the technology, the care, the services, the health of our children. And so Autism Speaks has got my vote.
Beautiful.
We invite our listeners to please check out Autism Speaks. So as we wrap up, we'd like to thank Corey Franco with Noble Bridge for his thoughts, and Kevin Carter of EMQQ for his thoughts, and for sponsoring both the live ETF Think Tank Exchange and this podcast. You can learn more about the ETF Think Tank and the Think Tank Exchange by visiting etfthinktank.com, your source for ETF ideas, thought leadership, strategies, tools, and growth tactics.
Until next time, keep the exchange going with your clients. I'm Dave Armstrong.
And I'm Kedar Wilson. Take care.
The views and opinions expressed during this event are those of the participants and do not necessarily reflect the views of the sponsor or organizer. Information set forth during this event has been obtained or derived from sources believed by the participants to be reliable. However, neither the sponsor nor the organizer make any representation or warranty, express or implied, as to the information's accuracy or completeness, nor does the sponsor organizer recommend that the information shared during this event serve as the basis of any investment decision, and it has been provided to you solely for informational purposes only, and does not constitute an offer or solicitation of an offer or any advice or recommendation to purchase any securities other than financial instruments, and may not be construed as such.